Hello, my name is Ben MacNevin from Montgomery Investment Management, and welcome to this week's video insights. Well, the share market has certainly jumped out of the gates since the start of the new financial year. Since July, the ASX 300 has increased by 10%. Meanwhile, interest rates are at record lows, with term deposits only returning 3 to 4% annually. This has prompted many people who have maturing term deposits to consider putting their money into the market. Many of the inquiries that we've received at Montgomery Investment Management are from people that have had limited exposure to equities in the past, and they're wondering how to invest. Should I buy stocks myself? Should I track the market? Or should I get other people to manage my investments? At Montgomery Investment Management, we are unable to provide financial advice, but we can fully inform people on the risks involved with holding equities. You see, unlike a term deposit, there is a risk of capital loss, which is why the required return for equities is higher than putting your money into a savings account. Unfortunately, many people do not fully understand this concept and rush into the market in the fear they are missing out on potential returns. Now, in the short run, share prices fluctuate considerably, and there is no telling how long this current period of appreciation will last. A much sounder strategy is to manage your investments from a long-term perspective. This involves taking an interest in companies that have a positive earnings profile regardless of the state of the economy. Now, while the share prices of these companies may rise or fall, the prices in the long run should reflect the underlying value. By way of example, let's compare two companies that many of you would be familiar with. In the past 3 months, the share price of BHP has risen by 15%, as iron ore has stabilised and the outlook for China has improved. By contrast, Woolworths' share price has only increased by 6% during the same period. But if you look at the performance of the two companies over the past 5 years, we see that Woolworths has grown its earnings per share by 40%, while BHP's earnings per share has fallen by 4%. Now, not accounting for dividend reinvestment, Woolworths' share price has risen by 30% over this period, while BHP's share price has remained virtually unchanged. The share market contains both exceptional companies and those with minimal long-term advantages. So by simply exposing yourself to the market because prices are increasing, may not appropriately account for the risks involved, and you may subsequently be disappointed by the eventual returns. Investing in equities can provide reasonable returns over the long run if the risks are effectively managed. So if you are thinking of moving your money away from the safety of cash, take the time to understand the risks involved instead of making a decision on the spot. Yes, you may miss out on rising prices in the short run as cyclical stocks drive the market higher, but you'll be better placed to protect your hard-earned capital when optimism inevitably fades. Thanks for joining us this week. As always, follow us on Twitter and Facebook.